There is a common belief that investing in stocks is only for the wealthy. Many people think they need thousands of dollars just to get started, and because of that, they never take the first step. But the reality is that times have changed. In 2025, technology, market accessibility, and financial tools have made it possible for you to start building wealth with as little as $100. And yes, that single $100 bill in your pocket could be the start of something huge for your financial future. This is not about gambling, guessing, or throwing money into some random stock you heard about on social media. This is about using proven methods, realistic expectations, and modern investment strategies to turn even a small amount into something meaningful over time. Because here is the truth: success in the stock market is less about the size of your starting capital and more about your strategy, patience, and discipline. Let us break it down step by step so that by the time you finish this, you will know exactly how to take your $100 and start building a real investment portfolio in 2025. First, you need to change your mindset about investing. Many people delay starting because they feel the amount is too small to make any difference. But investing is not only about how much you start with, it is about building the habit. Think of it like going to the gym. If you wait until you can afford a personal trainer, premium supplements, and a fancy membership, you may never begin. The real power is in taking consistent action with what you have right now. That $100 is your starting point, not your limitation. The next step is to choose the right platform. In 2025, commission-free investing apps and brokers have completely changed the game. A decade ago, if you wanted to buy a single share, you could be charged $5 to $10 per trade, which would eat up a huge percentage of your $100. Now, platforms like Robinhood, Webull, Fidelity, Schwab, and eToro offer zero commission trades and fractional share investing. This means that even if a single share of a company costs $300, you can still buy a fraction of it for $10 or $20. That makes the stock market more accessible than ever before. When selecting a platform, make sure it is regulated, easy to use, and has features that match your needs. Some apps focus on social investing, where you can copy the trades of experienced investors. Others focus on educational tools for beginners. Avoid shady platforms that promise unrealistic returns or require massive withdrawal fees. Remember, your first goal is to learn the process while keeping your costs low and your risks under control. Once you have your platform ready, it is time to decide what to invest in. With $100, diversification, meaning spreading your money across many investments, is still important, but you need to be strategic. This is where exchange-traded funds, also known as ETFs, can be your best friend. An ETF is like a basket that contains shares of many companies. For example, the S&P 500 ETF includes the 500 largest companies in the United States. By buying just one share or even a fraction of this ETF, you instantly own small pieces of all those companies. This reduces your risk compared to buying a single stock. Some of the most popular ETFs for beginners include SPY or VOO for the S&P 500, QQQ for technology companies, and VTI for the total US stock market. In 2025, there are also thematic ETFs, such as those focusing on renewable energy, artificial intelligence, or healthcare innovation. With fractional shares, you can split your $100 into small investments across different ETFs, giving you exposure to multiple sectors with very little money. But what if you want to own individual stocks? That is possible too, thanks to fractional investing. Let us say you admire a company like Tesla, Apple, or Microsoft, but their share price is out of your budget. Instead of waiting until you can afford a whole share, you can invest in just a portion of it. This allows you to slowly build your position over time, adding more whenever you have extra money. The key is to choose companies you understand and believe will perform well over the next 5 to 10 years. Avoid chasing hype stocks that rise quickly due to social media buzz, but have no solid business fundamentals. Remember, with only $100, you cannot afford big mistakes, so every decision should be intentional. Now here is where many beginners get stuck. They want to know how fast their $100 will grow. The answer depends on several factors, including market conditions, the type of investments you choose, and how often you add more money. If you simply invest $100 once and never add to it, your gains will be limited. But if you use this first $100 as a seed and commit to adding even $10 or $20 every month, the effect of compounding can become powerful. For example, if you invest $100 in an ETF that grows an average of 8% per year and add $20 monthly, after 10 years, you could have over $3,700. That may not sound like a fortune, but remember, it started from a single $100 bill. The habit and knowledge you gain during that time will be worth far more than the money itself because you will have built the skills to manage larger amounts later. Another important step is to understand risk. Even with $100, you need to know that stock prices go up and down every day. Your balance may be $102 today and $97 tomorrow. This is normal. The biggest mistake new investors make is panicking during small drops and selling at a loss. Successful investors think long-term. They see these dips as opportunities to buy more at a cheaper price. In fact, some of the best investors in history became wealthy not because they avoided market drops, but because they used them to buy at a discount. Here is something many people overlook: reinvesting your earnings. If your investment pays dividends, which are small cash payments companies give to shareholders, you can choose to reinvest them. This is called a dividend reinvestment plan, or DRIP. It may seem like small change at first, but over years it can significantly increase your returns. You should also use your $100 as a learning tool. While the amount itself is small, the process of researching stocks, placing trades, and tracking your portfolio is extremely valuable. Treat it like a hands-on financial education. Read company earnings reports, follow market news, and learn basic investing terms like P/E ratio, market capitalization, and dividend yield. By doing this with a small amount of money, you reduce the risk of losing big while gaining real-world experience. One of the most powerful habits you can build from the start is automation. Many investment apps allow you to set up automatic contributions. Even if it is just $5 a week, this removes the pressure of deciding when to invest and ensures you are consistently building your portfolio. This habit is far more important than trying to time the market or waiting for the perfect moment to buy. Now let us address the elephant in the room. Can you really get rich starting with just $100? The honest answer is that $100 alone will not make you rich overnight. But here is the reality: no great investor started with millions. Warren Buffett, one of the most successful investors of all time, began with small investments as a teenager. The difference between those who succeed and those who do not is that successful investors start early, stay consistent, and keep learning. Your $100 is a seed. If you nurture it with regular contributions, smart choices, and patience, it can grow into something significant. The earlier you start, the more time your money has to grow. This is why starting now, even with a small amount, puts you ahead of the majority who are still waiting for the right time. Imagine your $100 is a tree seed. Every month you water it with a little more money, and every year it grows a bit taller. At first it will look small and unimpressive, but after years of consistent care it becomes something strong that provides shade, fruit, and even more seeds to plant elsewhere. This is how wealth works. It begins slowly but compounds into something much greater than the sum of its parts. As we move further into 2025, another trend worth considering is fractional ownership of not just stocks, but also other assets like real estate and art. Some platforms allow you to invest small amounts into rental properties or digital assets alongside your stock portfolio. While you should not spread your $100 too thin at the beginning, being aware of these options can help you diversify in the future as your capital grows. And finally, here is your action plan for today. First, choose a trusted investment platform that offers zero commission trading in fractional shares. Second, split your $100 between 1 or 2 broad market ETFs and possibly a fractional share of a company you believe in. Third, set a small automatic monthly contribution to keep building. Fourth, track your progress and use this as a learning experience. And most importantly, resist the urge to sell every time the market dips. Your goal is to build wealth slowly and steadily.